Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. For over 2 decades, HDFC Bank was the undisputed king of compounding in the Indian stock market. It was a stock you could buy blindly and sleep peacefully. But over the last year, things have changed. While the Nifty 50 has been scaling new peaks, HDFC Bank has been stuck in a prolonged time correction. Right now, it's trading in the 775 to 785 zone, down over 20% from its 52-week high. So what's going on behind the scenes? Is India's largest private lender facing a structural collapse? Or is this a rare, generational buying opportunity at a deep discount? Let's analyze HDFC Bank's latest financial numbers, management's hidden strategy, and the breaking news that could trigger its next big rally. The Q4 financial reality check. Let's start with the hard numbers from the recent quarter. HDFC Bank delivered a stable performance, reporting a net profit of 19,221 crore rupees, growing a healthy 9.1% year-on-year. But look closer at the operational metrics. First, net interest income came in at 33,082 crore rupees. Core lending income growth was modest because funding costs across the banking system remain sticky. Consequently, net interest margins, or NIMs, leveled out at 3.38%. Second, the absolute highlight of the earnings is asset quality. Gross NPAs dropped from 1.33% last year to a spectacular 1.15%, while net NPAs stand at a microscopic 0.38%. Simply put, active credit stress is completely missing from this portfolio. To reward shareholders during this consolidation, the board declared a final dividend of 13 rupees per share, bringing the total fiscal payout to 15 rupees and 50 paise per share. The management's fortress. So, if the profits are solid and bad loans are low, why isn't the stock skyrocketing? It all comes down to the mega merger with HDFC Limited. Post-merger, the bank inherited a massive mortgage book without an equal amount of low-cost retail deposits. This inflated its loan-to-deposit ratio. But CEO Sashidhar Jagdishan and his team are pulling off a brilliant tactical reset. Instead of chasing risky corporate loans to boost short-term revenue, management is aggressively pursuing a deposit-first strategy. Gross deposits grew 14.4% to cross 31 lakh crore rupees, easily outpacing credit growth at 12%. Crucially, nearly half of those new deposits are granular retail liabilities under 3 crore rupees. Management is treating their massive customer base of 100 million as a direct funnel for low-cost savings accounts. They've also stated they are sacrificing raw NIM growth to defend a robust return on assets benchmark of 1.9%, while keeping a massive unallocated provisioning buffer of 125 basis points just to insulate the balance sheet against future global shocks. Unpacking recent media headlines. The media circles have been buzzing with critical news surrounding the bank over the last 90 days. First, on the corporate governance front. Following the abrupt departure of the former permanent chairman, the RBI extended financial veteran Keki Mistry's tenure as interim chairman. Concurrently, independent legal reviews and internal probes into marketing expenses are ongoing. While this creates a short-term media overhang, a permanent chairman announcement expected around the August annual general meeting will provide much-needed long-term clarity. Second, in the global markets, HDFC Bank successfully priced a massive $750 million offshore bond sale. Oversubscribed by global institutions, this deal shows that foreign smart money is highly confident in the bank's long-term creditworthiness. Domestically, HDFC Bank also raised its marginal cost of lending rate, or MCLR, by up to 10 basis points, which will help insulate their interest margins moving forward. Valuation and the future outlook. This brings us to the ultimate question. Is the stock attractive right now? Historically, HDFC Bank traded at a massive valuation premium. But today, it is trading at a trailing PE of just 15.7 times. Its price-to-book ratio is hanging near a rare multi-year low of 2.05 times. For context, its historical 10-year average PB was well over 3.2 times. Peer banks like ICICI Bank now trade at an explicit premium over HDFC. Looking into the future, the worst of the margin compression is behind us. A major upcoming catalyst is the RBI's subsidized FCNR deposit scheme. Global brokerages like Nomura estimate HDFC Bank could capture 15% of these total dollar inflows, which will heavily boost its deposit franchise and accelerate growth into the next fiscal year. Plus, the bank's upfront capital expenditure is done. Its 9,700 branches are now fully maturing, which will act as low-cost engines to scale fee income from subsidiaries like HDFC Life and HDFC AMC. The verdict: if you are a short-term trader looking for explosive momentum, HDFC Bank might test your patience as it wraps up its post-merger cleanup. But if you are a structural, long-term investor focused on capital preservation, acquiring India's dominant banking powerhouse at nearly 2 times book value offers an excellent margin of safety. Most major global research houses hold strong buy ratings, with target prices ranging from 940 rupees to 1,150 rupees per share. What are your thoughts on HDFC Bank? Are you accumulating at these levels or waiting for more clarity? Let me know in the comments below. Don't forget to like, share, and subscribe to get the sharpest stock market analysis. See you in the next video.